Hello again, everyone, and welcome back. I'm David Russell, professor of insurance and finance, and I come to you from Northridge, California, famous not only for my university, Cal State Northridge, but also for the January 1994 Northridge earthquake. This catastrophic event disrupted lives as well as the property insurance market in California. We continue to live with the results of this earthquake. As I was enjoying this morning's program, my university's central alert system notified me that it was time to practice the annual ritual, the California Shakeout. As for the insurance market disruption, the California legislature responded to the earthquake in 1996 with the creation of the California Earthquake Authority. I'm delighted to introduce the CEO of the California Earthquake Authority, Glenn Pomeroy. Since 2008, Glenn has led the not-for-profit CEA, the largest earthquake insurance provider in the US and one of the largest in the world. The CEA insures not only its policyholders, it also grants mitigation funds to homeowners who retrofit their homes for protection against seismic activity. Originally from North Dakota, Glenn served his native state as a state legislator when he was elected at the ripe old age of 22 as a county prosecutor, an elected state insurance commissioner, and he also served as president of the NAIC. He later worked in the private reinsurance industry in Kansas City before moving to California. Glenn, welcome to the CPCU All Industry Day.
David, thank you very much. And you can hear me okay, right?
Yes, we can.
Excellent. All right. Thank you, sir, and thank you for all of you for being here. You know, it's a delight to visit with you. I talk about earthquake insurance a lot to a lot of different groups, and sometimes to a bunch of folks who, you know, insurance is not really their first language. It's really pleasant to be with you all, not only insurance professionals, but professionals who are striving to improve your knowledge and your credentials and advance in this important profession. So happy to be here. Thank you very much for the invitation, and happy to spend a moment talking about the preparing for the really big one, and how the California Earthquake Authority fits into that whole picture. Let me just begin by briefly describe. Can I ask you, David, is there a slide before this, or is this the first one?
This is the first one I have.
Okay. We tried to drop in a plug for the shakeout drill, which you've already talked about, but I'll just spend a second verifying what you just said, and that is this is an important day, and the drill has occurred this morning. That doesn't mean we still can't talk about it, because the shakeout drill is the largest earthquake preparedness drill in the world, and it happens on the third Thursday of every October, which is today, the 19th of October, and the way they have it set up is. Today on October 19th, this drill happened at 10:19 on 10:19 in 2023, and it's just, as you probably have participated in the past, and maybe even did this morning, an opportunity for us to just spend a second focusing on what to do when the ground starts shaking, and that's just drop to the ground, cover your head, and hold on, and it's worth repeating because we've been doing this for a long time now. I think the first drill was in 2008, and I just came off a TV interview and was asked the question, well, aren't you supposed to run to a door frame? And that's the worst possible thing you could do. It is what they used to teach, but now it's understood that that door frame isn't going to help you any. What you're doing is putting yourself in harm's way from the things that are falling from the walls and the ceiling that are looking for your head and want to hurt you. So drop to the ground, cover your head, get under a table if there's one handy, but don't go looking for one. Immediately respond, drop to the ground, cover your head, and hold on until the ground quits shaking. A month or two ago, there's an earthquake down in LA, and I watched a video that was taken at a restaurant, a security camera, when the ground shook and the camera was shaking, and you could see the people getting up and kind of wobbling around trying to figure out what to do, and they were doing all the wrong things, because fortunately no one was hurt, but they could have been if things would have been flying around. a reminder that we need to know what we're doing. And one more little quick example, then I'll get on with things. But we had an earthquake in Northern California yesterday. Not not a big one, but enough to cause some shaking up here in Sacramento. Don't tell anybody this, but I was in a meeting at the Capitol with a legislative staff member and another fellow. We were sitting around a table having a conversation about earthquake of all things, and our our phones went off simultaneously, all three of ours. Of course, our phones were in our pocket, and none of us wanted to interrupt the meeting by seeing if we had a phone call, so we didn't look at what was coming in until we realized we're all buzzing. We pulled out and realized that we had, an alert had just happened, and then by the time we figured that out, it was a little shaking that we could feel in the room. Not a lot, but the point is, Mr. Promoter of Shakeout Drill didn't respond to the alert that I received. Shame on me. We all need to keep this in mind because earthquakes happen in California. They're going to happen again. The tragedy that unfolded in Northridge over 25 years ago, that'll happen again somewhere, sometime, and we just all need to be prepared. So on with things. In terms of the California Earthquake Authority, we were formed in the wake of Northridge, and I'll talk a little bit more about that in a second. But fast forward today, now the California Earthquake Authority has over 1 million policyholders. We're publicly managed, but privately financed. We're not in the state budget. We don't have state tax dollars behind us, but over $19 billion in the ability to pay claims for those 1 million policyholders when a big earthquake happens. More on CEA in a bit. We also have this grant program we call the Earthquake Brace and Bolt program, where we provide mitigation grants to homeowners to help them retrofit their older homes. We don't have unlimited funding, but over time, this number should be updated that you see here. We've helped 22,000 homes get retrofitted since we launched this program a while ago, which we feel really good about, but we're not breaking our arms, patting ourselves on the back because there's over 1 million homes that need it. So it's a good start. And we just got to keep at it. And then finally, I'll talk more about that in a second. What I won't spend much time talking about is that third logo. We a while ago were asked to administer what's called the California Wildfire Fund, which isn't an insurance program in the sense of providing coverage for homeowners. It's really a financial backstop for the investor-owned utilities in case their equipment causes a fire and they were acting properly and not negligently, and they were maintaining their equipment, investing in safety. If they can demonstrate that, they'll and if their equipment causes a fire, they're eligible to some reimbursement from this fund, which just helps keep them in business and keeps the light on in California. So that's the wildfire fund, but that's a sort of add-on to our primarily earthquake responsibilities, which is really what I'm here to talk about today. So we go to the next slide, please, David. So I'm sure there's no one who doubts this. Earthquake risk is real in California. I don't know where you all live, but we've done a pretty good job in California of populating most of the state's population right along that nasty red gash that runs along the west coast, the San Andreas Fault and all the faults that spin off from it. But we're up here. I'm in Sacramento, and that's more up in the Central Valley. And we shook yesterday. I wasn't here then, but I'm told this place shook in 1989 when Loma Prieta struck, and residents here saw some significant shaking. There's no place in California that's not earthquake country. Some regions are obviously more exposed than others, clearly, and good share of our state's population happen to live there. So it's an issue that we need to take seriously here in California. Next slide. So let's talk about how this thing came into being, but let's wind the clock back even further before the Northridge earthquake struck, way back in prehistoric time when personal computers were first arriving on the scene, 1984. That's the year that the California Supreme Court and the legislature basically constructed a mechanism whereby the peril of earthquake was specifically excluded from the underlying homeowners policy that you sell. However, companies picked up the requirement to offer earthquake insurance when that homeowner's policy is sold, mandatory offer. got to offer it when you sell a homeowner's policy. You don't have to offer a CA policy. In fact, we didn't exist at that time, but companies have to offer it. And for the first decade or so, they were putting it on their own books, and they weren't all that worried about it because they didn't really have a handle. They couldn't have really understood the tremendous seismic risk that is underneath our feet that they were taking on and insuring through these earthquake policies that they were issuing. Well, that in fact, even the 1989 World Series earthquake didn't shake that sort of mindset because it didn't produce a lot of residential damage. But David, on the next slide, the that all changed when the Northridge earthquake struck. I don't know if you were living there at the time, David, but it was a frightening moment. Obviously, a big one, 6.7, hit in the early morning hours when most people are still sleeping. One of the costliest natural disasters then in the history of the United States. $20 billion in residential damage. So obviously much more in terms of property damage when you consider homes and hospitals and all the other buildings. And then when you think about the bridges that collapsed and all of that, it was a very costly disaster. And unfortunately, it was a deadly one too. Some 67 lives were lost. Most of them, I shouldn't say most of them, a lot of them were asleep in their beds in the Northridge Meadow apartment complex that just simply collapsed when the ground shook because it wasn't built to withstand the damage. So it was a terrible event. And out of that came the view from the industry that they're done right in earthquake insurance. The tremendous amount of losses they paid out back then caused them to say no more new policies. If we're stuck writing earthquake insurance, we're just going to not write homeowners insurance anymore. And for those of you who were not in the business at the time, the market crisis that existed then was far worse than the one that we've been experiencing this summer, because no company were writing new policies. Housing in building industry came to a standstill. Something had to be done. The legislature refused to drop the mandate and instead ultimately took a year or so, but they ultimately created this thing called the California Earthquake Authority. Here's how this thing fixed the problem that existed, the market breakdown that existed. Here's how the CEA fixed that. The CEA, we're a residential earthquake provider. So we issue earthquake insurance. It's voluntary. Nobody has to buy it. Companies don't even have to sell they don't have to join us. In fact, several companies are out there operating outside of the CEA, and that's fine. When they sell earthquake insurance, they're selling their policy on their own book, which is good. We want to open competitive market. But most companies join the CEA, and once they paid to join and came in, they could continue then to sell homeowners insurance and satisfy their mandate to offer earthquake insurance by offering the policy for which CEA bears the risk. We are required by law to charge rates that are actuarially sound and also rates that are based on best available science. And those are important words to us because there is a lot of science out there that is developed through USGS and the scientific community, scientific seismic findings that work their way into models that we use. And we're required, in fact, by law to use that when we establish our rates. We're not funded by the state. We have no state backing whatsoever. So our policyholders are really the ones who bear the risk, and we manage it for them. And we collect the premium from them and manage the risk on their behalf for when they need it, when claims need to be paid. But we're publicly managed. The board of directors that I report to consists of the governor, insurance commissioner, and state treasurer. They're the voting members, and the two leaders of the legislature of one from each of the bodies are the non-voting members. So we're privately funded but publicly managed. We're unique. We're a hybrid, and we operate on a not-for-profit basis. So, in a nutshell, that's who we are, and all those things create, uniqueness for us, and also create some challenges that we're working through. But in an introductory nutshell, that's how the CA was structured. Next slide, please. So I mentioned that companies could join the CEA, and these are the companies who did, either initially or over time. They became what we call our participating insurers. So not to single any out, but just grab any one. Look at State Farm or Farmers on the top there, or Progressive and Safeco down below. Any one of them. The company's obviously in the business. The agents do their work through State Farm or whomever. But when it comes time to offer an earthquake policy, those agents can offer our policy because they are a member of they're a participating insurer of the CEA, and therefore, and I see a question come in, and by the way, I'm not very good at reading and talking. So, David, if you can maybe help keep track of questions, and we'll circle back to them. But if you want to call one out while I'm at the moment, please feel free. Um, so State Farm continues to be able to write homeowners insurance without taking earthquake insurance on their books, because when they sell a CA policy for which we bear the risk. Next slide, please. Okay, I got to spend a moment talking about this. This is what we call our beloved claims paying capacity tower. Think of it as a series of building blocks. And let me spend a moment just describing it, because it's relevant to some of the challenges that we're working through now. They're arranged in boxes, and they're stacked on a tower because when an earthquake happens, we will go to the bottom of the tower first and start paying claims out of that blue box. We pay from the bottom up of our tower. And that first layer then is the money that we have collected from our policyholders, the capital that we've invested conservatively on their behalf. CA capital, a little over $6 billion today. But we actually need to meet the claims paying capacity level that the board has established. We need about $20 billion in claims paying capacity, and obviously 6 is well short of that. So we go out into the global reinsurance markets and buy a ton of reinsurance. I don't say this to brag, because it's actually a pretty tough thing to deal with. But we are the largest buyer of reinsurance, catastrophe reinsurance, in the United States, and the second largest in the world. We need so much risk transfer in order to manage the risk of these policies we take in at such a strong financial position that we're almost positive we're going to be able to pay 100% of our claims. We just have to transfer a lot of that risk into the global reinsurance markets. And this year we're going to spend about $600 million on it. So it's we're pretty heavily dependent on reinsurance. The other layers.
I'll give you a little break there, because you've
Yeah.
been talking for a while, and this is fascinating to me. I am a CEA policyholder, and I'm happy to have paid you a lot of money and never have asked for anything in return yet.
Well, that makes one of you.
Yeah.
Thank you, David.
So the reinsurance panel that you have, are you on a 1/1 renewal? What's your sort of season for that?
We we have 120 reinsurance partners. So they're not all 1/1 renewals. A long time ago, we used to do our whole reinsurance acquisition in one fell swoop. But as we grew larger and need so much of it, it came more to our advantage to layer them in over time. We have 1/1 renewals coming up, but not for our entire reinsurance purchase. And some of our treaties are multi-year in nature, so they're not all just 1 year. So it's kind of elaborate and multi-layered.
That makes sense. In terms of what wind and wildfire have done to you, even though you're not the offender, I would imagine that those same pools of capital are stressed, and that falls on you to some degree.
Yep. Again, really nice talking to someone who understands all this stuff, because that's exactly right. Our reinsurance costs are going up, even though we have not had a reinsurance claim in our 26-year history. Why are they going up? Well, because reinsurers are getting clobbered through the events around the world: fire, hurricane, climate-driven. But they manage their book and they require return on investment. And we've got into a very hard reinsurance market over the last couple of years, which has hit us in a couple different ways. For most of our reinsurers, we're their largest customer, believe it or not, for natural catastrophe reinsurance. And I don't like being in that spot, but we are. When we meet with them, they say, you've got all the capacity from us we can provide to you. Sometimes they'll add on, but if you want a little more, maybe we can talk, but you'll have to pay a lot more for it. So we've been stressed in terms of how much capacity is available to us. It's been declining. At the same time, the price has been increasing. So capacity has shrunk, prices have risen. All the time exposure is going through the roof. And these things create challenges for us, which put great pressure and need for rate increases or other changes. And that's what we're working through still today. But yeah, we buy a ton of reinsurance. And I'll show you in a second how much that's grown over the last several years. Some other sources too, but kind of more technical in nature. We have capital available from revenue, but we've issued some debt and can tuck those away into a layer that's on top of our reinsurance layer. But that's basically capital to us as well. We do have the ability to, by law, to surcharge our policyholders to no more than $1 billion total. If that amount is needed. And then finally, the companies who participate with us have some contingent liability still. If there's an earthquake so large that we blow our capital, get through our reinsurance, exhaust all those other layers down below, we can go back to our PIs and assess them a total of $1.7 billion, broken down by their market share. And you add all those up, and that's where we get our almost $20 billion worth of claims paying capacity. Before I leave the slide, though, let me just point out a couple more things. To the left of the tower, about halfway down, you see 13.5 billion, 1906, San Francisco. The San Francisco 1906 earthquake, if that were to reoccur today, that would produce for us about $13.5 billion worth of claims that we would be responsible for. Of previous earthquakes that have happened in California, that's the most damaging if it were to reoccur today. Northridge would be tough for us. It would be about a $9 billion hit. That's a lot. But it's a little less than half of our claims paying capacity. So we're set up for almost two Northridges from a financial strength standpoint. This tower represents enough to manage through what's called a 1 in 350 year return period. You know, you read about flood being 1 in 100 and things like that. We're at 1 in 100, 1 in 350. And so what does that mean? That means that there's a very, very, very small likelihood that an earthquake that will happen that will exceed all our claims paying capacity, less than 0.5% of a chance, only a 1 in 350 chance that it'll occur. But what happens if it did occur? Well, the state statutes provide for that too. In our case, we're one and done. And after a extremely unlikely earthquake, there's almost a 0% probability of it occurring, but it could. If it's beyond the amount that we have, let's say a $21 billion event for us, and we only have 20, we then start paying claims on a pro rata basis, and someone would get 98% of their claim paid, or 95%, depending on how much more massive the event was. I actually don't lose, personally, I don't lose sleep about an earthquake outstripping our ability to pay claims. 1 in 350 is extremely strong by way of a financial benchmark, as recognized by the rating agencies. The problem is staying at that level requires so much claims paying capacity, so much reinsurance at such a high cost that the price of our products is getting pretty expensive. But it's unavoidable, and it's not getting expensive because we're lining our pockets. We're not for profit. We're here to provide earthquake insurance for Californians. We have a public mission, but the math is what it is. And to fill up this claim paying capacity costs us a lot. And it's not us, it's our policyholders who pay those costs. So that's why I want to spend a moment talking about the financial tower. It all relates to the challenges that we're facing. Okay, thank you. So what's happened to us? Well, over the last 10 years, go back to 2012 and just look at the bottom below the dotted line first. In 2012, we had 842,000 policyholders, $313 billion worth of total insured value there at the bottom, and $223 billion in reinsurance costs on the far right. So 842,000 policyholders, 313 billion total exposure, and $223 billion in annual reinsurance spend to meet that risk. Fast forward then to today, in 2022, our policy count has grown by 27%. We've grown over the past decade by 27%, but look what has happened to our total insured value, more than doubled. Why is that growing faster than the policy count is growing? Inflation just driving up the cost of the amount we need to driving up the total insured value of the homes because of inflation just means that we have more exposure to manage because we're on the hook for more as a result of that inflation. And then finally, our reinsurance spend to meet that exposure growth has grown at even a higher clip because reinsurance pricing has been hardening or rising during these hard reinsurance markets. So while our policies have grown 27%, the amount we have to spend on reinsurance has grown by 122% at the end of 2022. And I can just update these slightly. We project now by the end of 2013, our policies are going to decline just a little bit. And the total delta between 2012 and the end of 2023, we think it's going to be more like 23% by the time this year settles out. However, total insured value has continued to rise. We believe our total exposure at the end of this year will be more like 111%. And if you need evidence of a hard reinsurance market, let me tell you this. Our total reinsurance spend from 12 to end of 23 will have risen by about 165%. So they're the throes of the horns of the dilemma that we're navigating through and taking a lot of action steps to manage through these headwinds.
Glenn, there's a question in the chat about whether or not the CEA purchases parametric coverage.
We do not. There's not been a form of risk transfer that's been available to us. We do some work in the capital markets, but it's just a little different than strictly a parametric product. And we don't issue parametric insurance either. It's all indemnity.
Right.
Our current policy options, pretty standard. We insure the replacement value of the home. Now we insure personal property up to $25,000. It used to be up to $200,000, but that was just driving our exposure through the roof. And so recently we pared back to $25,000. The mini policy in state law is $1,500. So it's far more than the mini policy. It's what 70% of our policyholders purchase less than $25,000, but we have recently reduced down to 25, and that means some are going to see a drop in how much personal property protection they have from us, which I'm sure some will not appreciate, without realizing that we're doing it to keep their costs from rising. Is still going to have the availability to buy up to $100,000. A wide range of deductibles for most policyholders. Now, if you got an older home and you don't get them retrofitted, you're going to not be able to have a 5 or a 10% deductible. You're going to be back with 15, 20, or 25 is another incentive to try to get those older homes fixed up. And then a couple of other things as well. Those are the essential elements of the CEA policy. Next slide.
Glenn, before I go, I've got the power of the mouse here.
Yes.
You fortunately haven't had many claims at all since you've been in office or the CEA has been around. But obviously, if the big one or even the half big one hits, how do you will the participating companies be the adjusters on the?
Yes.
Oh, I see. Okay.
Yeah. Just like we don't have agents, we don't have adjusters either. So it'll be the adjusters of our participating insurers who will be out in the field doing the work pursuant to CEA claims paying guidelines, overseen by us at a sort of a broad level. But when earthquakes do happen, one in Humboldt County in December, or Napa in 2014, or when Ridgecrest 2019, when they do happen, um, our message to the public is call your agent, get a hold of your company, get that claim filed, and get on that as soon as you can. So that's the response mechanism.
And Glenn, while I still have you, I'm getting some traffic in the chat. One observer feels like the high deductibles are maybe an impediment for some. I bought mine down a little bit, but it isn't free, nor should it be. Has I assume that you've never considered a dollar deductible as opposed to a percentage or something at zero?
That would just drive the price of our overall product through the roof. The mini policy is 15%. The bare what we have to offer is at least 15%. We rolled out a 10% option quite a while ago. We took it down to 5% option more recently. So someone can get down to 5%, but lower than that, I don't anticipate us being able to allow for that. The fight right now is to try to keep rates from going through the roof. We had a CA board meeting yesterday in which we talked to them about possibly needing to file a rate increase before this year's out in the range of 20%, 20% rate increase. What we hear more from folks is, yeah, no one likes deductibles. But what we hear more from folks is the price. Just hard scraping the funds together to buy an earthquake policy on top of the homeowners policy, and we totally understand that. So the challenge we face is keeping a product available that is as affordable as possible, backed by as much financial strength as we can, because we want to be here to honor our promise when the earthquake happens. And if it was easy to do, the private market would still be doing it, but they walked away from it for reasons because the catastrophic risk is company threatening. And so this CA structure was created to take this risk on and set up in kind of a unique way that allows us to handle it in such a way that we're more than twice the size of the next largest writer in the United States that writes all over the country. We write only in California, and we're twice the size of the number 2 countrywide writer. In California alone, we write more policies than the next 9 writers combined. So we really are taking on a risk and a magnitude of risk that the private sector can't. And I wish we could do more. Wish we could, have rates lower, offer even lower deductibles or more coverage here and there. But it's about striking the balance. And you got a big old balloon, and you push somewhere, and it pops out somewhere else, and trying to thread the needle to get it lined up right is something we constantly strive to do.
Right. Another person points out the sort of the specter of a policyholder surcharge. If you were to have a big claim, that would be on top of any of these increases, and I'd imagine reinsurers would also want to collect more. So after a big event, it would be it would certainly be more expensive.
Yeah, it would take a really, really big event to get up to that policyholder surcharge layer, but it's there. Yeah. Another option would be to just charge for that now and not charge for it later.
Right.
There's some logic behind charging for it only when you need it, as opposed to each and every year when you probably don't. So that's part of the thinking there behind the surcharge.
And you're spreading it between those two. You're doing a little both.
A little both, yeah, a little both. But the surcharge very remote in terms of probability. And another question I saw just pop up. Did you catch that?
I did. So Christina observed that she saw a rate increase, but there really wasn't any private market alternative. I know there are some. I think you have a slide later on a couple of the private market
Yeah,
options,
we
but
do. Uh,
I
um,
know I know some of those don't. They're full up on their appetite in a particular geography.
that's probably true. They tell us the appetite is there though, and I don't know about their underwriting guidelines and so on. But GeoVera, Palomar, would definitely be worth a look, and maybe the person who submitted the chat already has. Um, but yeah, I mean, and unlike those entities, or unlike the companies who decided they don't want to take new policies on in the fire regions this year, we don't have that option either. We're guaranteed issue, take all comers. Uh, if you have a homeowner's insurance policy issued by CA participating insurer, you want a policy, you're going to get it. If your home's built on stilts, straddling the San Andreas Fault, you're going to get a CA policy. You want to buy it. That brings us another. I don't mean
Right.
turn this into a gripe session. we just got
Yes.
we got a series of challenges that make this a very interesting job.
Right. Vanessa, who's a panelist in our next discussion after this one, points out something I was thinking earlier, which is fire following. Some That's really not a CEA coverage, I'd imagine. I imagine that's on the homeowner's policy for fire following.
That's exactly right. Yeah, fire following stays for the homeowners. We just got the shake. I love the questions and the sophistication of them. This is fun. Um, uh, this slide you've all probably been on it, but if you got a customer who's looking into what was the CA policy cost, pretty easy to find out. Just go to our website, get on the premium calculator, click on get an estimate there, and I think, do I have another slide to show how this kind of works? No, I'm sorry, I did not do not. But if you click into it, you'll put in some information about where your home is located and when was it built and some other characteristics that we need in order to price it, and then click into it again. And I think our calculator is a pretty good tool, because you can get to a point where you have these series of sliders, and you can move the deductible slider from 5% to 25%, for example, and see what happens to the premium when you make that move. You can adjust your coverages from the minimum to how much the maximum that we offer, see the premium move, and do your best to find a policy that meets your own needs and budget. That information is kind of at your fingertips. You're in the driver's seat. Next slide, please. And then, yeah, real quick, and I'm sorry, I just realized I'm getting close to time. We are aware of these companies that do tell us they have appetite. Starting November 1st, we're going to put these companies on a website to let people know you don't just have to buy from us. In fact, it's in our interest to have a broader earthquake insurance market. So it does make sense to please check around. Am I right? I got about 2 minutes.
Oh, you've got about 7 minutes.
Okay. Could we go to the next? We're going to switch gears here just a second. I really want to talk about our mitigation commitment. It's really important. Earthquake Brace and Bolt program, and to illustrate the importance of it, we took this picture the morning after the Napa earthquake. We're driving around town, look at the damage. The home on the right was standing firm and strong, and the house on the left put up a barricade already because it was unlivable, obviously. The owner of the Blue House walked out. We started chatting with him and found out that his house had been retrofitted. Someone had gone into that crawl space and put in some braces and bolts years ago and tied that home into the foundation more firmly. It didn't wobble off the foundation. The home on the left was unlivable for several years. I understand it was a $300,000 or $400,000 repair job. So it's so important for older homes, especially built prior to 1940, even all the way up to 1989, that were built before building standards were stronger, to look into what it would take to mitigate that home, because in many cases it just doesn't cost that much. In the LA area, the broad LA, Southern California area, $4,000 or $5,000 often get the job done. If you got a crawl space of 4 feet or less, get in there, put in some braces and bolts, and takes a day or two. And if different kind of structures with maybe a garage under the living space is more complicated, more costly, and is going to require more money. But the sort of low hanging fruit is the homes that kind of look like this, and we have a mitigation program that provides some financing for those kind of retrofits. Next slide. Just to illustrate, say you're of the size who can fit in one of those crawl spaces, and you look around this, it would look like on its left, in the unretrofitted state, that home is just sitting on those vertical studs. And when the ground shakes, those things can't keep that heavy home standing up, and the house either topples off the foundation or collapses. But it doesn't take much. Put in some braces and bolts within that framework, wrap it in plywood, and you very much reduce the risk of major damage. So the before and after shot, and then next slide. So we have this grant program. Oh, I'm sorry. Could you back in? I'm sorry. That we do have this grant program, earthquake braceable, $3,000 grants to people who are selected. We don't have unlimited funds, but we come out with sign up periods every now and then, and over time we've retrofitted 22,000 applicants who go online and sign up and are registered. The next slide. There is a website that provides basic information for people to know what to do, how to strengthen their home. Strengthenmyhouse.com, good source of mitigation information in general. And then do we have a couple more? Yeah. So earthquake brace and bolt, real quick. Launched in 2014. Did a pilot in 4 zip codes, 2 in the north and 2 in the south. Had asked people to sign up for it. We had a few, drew names out of a hat, and retrofitted like a total of 8 homes. That was then, and then over time, this program has just grown. Next slide. By I think it was 2018, we were in 177 zip codes. Zip codes selected by 2 categories: high seismic risk and high concentration of old building stock. So by 18, we had grown to these zip codes, and today, one more click, we're in something like 521 zip codes, all along the fault system. Room to grow still, and we are growing. We've now done 22,000 retrofits, and beginning in January, I think it is, of next year, we're going to go out with a new sign-up period, and it'll be in more zip codes still, these plus some more. The final slide tells you you or your customers where to go to get more information about that sign-up period. 22,000 retrofits and counting. If anybody wants to sign up for the next round of financing, go to earthquakebracebolt.com, and the registration hasn't begun yet, but I think by going to that and getting on a list, you'll be notified when the registration period rolls around. And if you don't do that, just keep your eyes out, because I think it'll be out in January, and we'll be doing all the outreach that we can to make folks aware of it. We had something like 22,000 sign up last time. And so the sign up periods are usually pretty active. Oftentimes, if 22,000 sign up, about half of them don't complete the work. I mean, don't hang in there. They sell a house, or they kind of forget about it, or they change their mind. So we're usually able to get to everybody who does register, who really wants it. And then when more funding allows, we do it all again, which is what we're going to do in January. So thank you again for letting me talk about all this stuff. Really appreciate you giving me this opportunity. And if there are any more questions, I'd be happy to answer them. Or if you need to get on your next program, that's fine too.
Well, certainly, Glenn, the pleasure's all ours. I had sort of a conceptual question. I think you've done such a good job covering earthquake, although it hasn't been put to the an extreme test yet.
Right.
What do you think about a California wildfire authority? Do you think there's a place for a CEA style mechanism for wildfire?
Well, that's a good question. Well, we're out of time.
Right.
No, it's a good question. It hasn't been seriously proposed that I'm aware of. We do have the California Fair Plan. It's a place where people can go if they can't get fire insurance elsewhere. I know it's not a perfect solution for many. It costs a lot, and the coverage is limited. But it's not supposed to be a major provider. It's supposed to be an insurer of last resort. It's just that a lot more people are needing that last resort these days. So the FAIR plan is growing a lot, bringing with it a lot of exposure now that the industry is getting concerned about. So earthquake is different than fire. You don't have to have it. It is voluntary. Companies have to offer it. It has these unique features that allowed the CA to be structured uniquely. So this is kind of a long, rambling way of dodging the question to say we really haven't analyzed it. We, being the CA, haven't really analyzed it. It's not immediately clear to me how a CA-like structure would be a cure for the challenges in the fire country. I think it's really a matter of allowing the private sector to work. And I know there's some changes underway that are seeking to fix some of the flies in the ointment lately. And it'll be good to see how those changes play out and if they are effective in terms of dealing with some of the problems lately.
Glenn, thanks again for sharing
Yeah.
this time with us. It's been terrific to hear over your tenure what's happened, both to exposure and to pricing and what may be to come. But thanks again for
a wild ride. Thank you, David. I enjoyed seeing you.
Take care, and everyone will be back in about 5 minutes with our panel on insurance availability and affordability.